Hello, Zach McReynolds here of the Cherrie and Zach team, NextHome Real Estate Rockstars, Santa Clarita, California, coming to you from our offices in Valencia. We're actually over here by the Topper's Pizza at the corner of Magic Mountain and Valencia Boulevard, in case you didn't know. I would like to talk to you today about DTI, debt to income, DTI ratios. This word is thrown around a lot. What is a DTI? How do we calculate it? You might have heard lenders saying, it pushes your DTI limits or it's within your DTI limits. So we'll just take a couple of minutes and kind of go over this process, what it means to you, how to calculate it, and your expectations. It will help you figure out how much of a house you can afford. So let's start with, what is a DTI? It's a personal finance measure that compares the amount of debt you have to your overall income. So it's a ratio. A lender will only lend you a home at a value of this debt to income ratio, as far as it's broken down into your monthly payments and expenditures. So how much of a home you can qualify for falls within this ratio, what a lender's looking for, into your monthly ratio of your income versus your debts. So the lenders, including the people that give the money for mortgages, they use it as a way to measure your ability to manage the payments you make each month and repay the money that you borrowed. So a lower DTI, a lower debt to income ratio, means that you're a stronger buyer, versus if you had a really high debt to income ratio, then they look at that like you're on the verge of not being able to afford your monthly payments. And at some point, you're going to slip and something's not going to get paid for. Most lenders, when you're qualifying for a home, want that ratio to be somewhere between 40 and 45%. So your debt to income, all of your debts versus your income, should be between 40 and 45% in order to qualify for a particular property. So we take, how to calculate that. You add up all of your monthly expenditures, all your recurring monthly obligations. Your mortgage would be in there, but let's take mortgage out of it for a minute, because we're going to add this up to see what type of, how much of a mortgage you would actually qualify for. But auto loans, student loans, credit card payments, if you had child support payments, anything that actually shows up on your credit report would count. So like your electric bill, or gas bill, things like that don't count. It's just things that would show up on your FICO credit report. And you divide that by your month grossly income. So we're going to work it backwards. Let's start with how much money you make a month. Let's say you make $8,000 a month before taxes, your gross monthly income. So 8,000 times 0.40 or 40%, that comes out to 3,200, or times 0.45, 45%, that comes out to 3,600. So if you make $8,000 a month, your housing affordability falls somewhere between $3,200 and $3,600 a month. That does not count property tax or HOA or Melrose, but it's just the rough estimate. Now let's talk about your debts, and we'll circle back to that. So let's say you have a $500 car payment, of $400 in student loan, $200 in monthly credit card bill debt. You add those up, that's $1,100. So you subtract the $1,100 from your $3,600. Let's look at the high side there, that 45% of your $8,000, and you come up with $2,500 a month is what you can qualify for in a home. Obviously, your FICO matters because the interest rate you're getting, there's a whole lot of factors that go into this, including HOA, Melrose, property tax, all of that stuff. So let's take that calculator. Obviously, I did the numbers for you there, but well, let's do it the other way. Let's say, let's go look. Oh, geez. All right. Let's break down a monthly payment. So let's stick with the numbers that we said. We're basically saying that if you make $8,000 a month, you've got your car payment, your student loan, and your credit card debt. You're basically left at about $2,500 a month that you can qualify for. Rates right now are under 3%. Let's put this in. Let's say we're at 2.9 right now, and you are interested in buying, let's say, a $550,000 house. 550. This is the loan balance, the 550,000. So let's say you're buying a $600,000 house, you're putting 5% down, right? So 600,000, 5% down payment on that would be 30,000. Your loan balance would actually be 570,000. On a 30-year to 2.9, your monthly payment without property tax or HOA or anything. So that's right there. Saying you make $8,000 a month and you have those bills that we talked about: $500 car payment, $400 student loan, $200 a month in credit card. You're pretty much saying you're right around a $600,000 property, because we still have to factor in property taxes. So let's go factor that in too. Let's say you're buying a $600,000 house out here in Santa Clarita. We are at a 1.25% tax rate, 0.0125. That's how much a year you're paying in property taxes. So we're going to divide that by 12. That's your monthly dollar amount. So if we add that to the 2373, whoops, what did I do there? 625 plus 2373. Obviously, now you're at $2,900 a month, which then you fall out of that ratio because that's above that 45% that we were talking about. So that means you'd have to, rework that back down. And this is obviously what a lender does for you. This is why you should talk to a lender in the beginning of your home search. You really want to get all this sorted out before you even start looking at homes, because again, your credit's going to be factored in, what interest rate, all of those things are going to matter. You're going to get a monthly payment from the lender. We call it PITI. That's principal, interest, taxes, and insurance. That's not even factored into this right now. So you know exactly how much you qualify for a month. And then you, monthly payment, you reverse engineer that into purchase power. So all things total. And then, a good thing to look at here too is then, and this is why, again, talking to a lender up front is good. You've got that $200 a month in credit card monthly bills. What if you pay that credit card off? Now you don't have that $200 there. That can be applied towards your DTI. Although paying off your credit cards isn't always the best thing. So you might want to talk to the lender about that in the beginning, because they can help you kind of make that roadmap of, well, if you pay this one down a little, or you do this or you do that, this is how you're going to maximize, your affordability. And what you qualify for is also different than what you're comfortable with. Just because you qualify for a $600,000 house doesn't mean that you want to spend that much. Maybe you're more comfortable at the 500 range. And then, like I said, HOA, Melrose, and all those things apply on top of it. So I could stop talking here. And there's a lot to this, and it is confusing. Again, that's why starting by talking to a lender in the beginning, making that the first step of your process, is such an important part, because what you don't want is to, go off of one of these numbers you see on Zillow or something where it says, hey, this $800,000 house, your monthly payment is going to be $2,000 a month. That's not specific to you and your needs. They're probably assuming that you're putting 20% down. They're not factoring in property tax or Melrose or anything like that, or even the HOA either. So talking to that lender up front and getting that dollar amount so you can reverse engineer that out and go, okay, I cannot spend more than $543,000 on a house, or whatever your number is. That way we know what we're looking for when we're looking at properties. Again, my name is Zach McReynolds. If you have any questions about this or anything else real estate related, I am here to be your guide, your real estate expert, and help you on your path to home ownership. Talk to me. Let me know. I'll talk to you soon. Bye.